All right, welcome back to the Building Your Life podcast. My name is Doug Sandler, along with John Browning. John, what's going on in fabulous downtown Florida? Is there a downtown to Florida? Is there one downtown? There's many downtowns
There's
to
a whole
Florida.
lot of downtowns, right? We're in West Palm Beach here, so yeah, we are off to the kind of the side of downtown. But downtown's pretty cool. My son came down and he's like, "Dad, I had no idea there was a nightlife to West Palm Beach," and I was like, "Neither did I, but that's because I'm old." But
I know my nightlife ends around 8:30, 9 o'clock, and I'm in
yeah,
bed.
right. I'm like,
I'm with you. I'm with you. Hey, John, you had sent me over some great topics to talk about today. And one of the topics we were talking about is the difference between taxable and tax-free income in retirement. And
yeah,
this is a topic that I really want to get into today also. And hopefully, because there will be some math explained in this podcast episode, I'm hoping that we don't lose our listeners. But of course, if you do feel like you need more information, you can always reach out to John, and we'll provide that information at the end of the podcast. So, John, I'm excited. Where do we even start with this topic?
yeah. This is an often misunderstood topic, and it is often misunderstood by even some financial advisors. The the old story, right, is always max out your 401k and max out your IRA, and all that is good, but some really careful planning by somebody who really has the experience and knows what they're doing in conjunction with your tax advisor. This is not tax advice, but if you do it the right way and with the right planning and with the right number of years before you retire. So let me ask you a question. Do you think your Social Security is taxed when you get your Social Security, whenever you decide to take it, 65, 66, 67?
The only thing I know is that, at least from what I see with my mom's, and my mom is 90 and has been receiving Social Security for quite some time. The only thing I see in that check is that, don't they withdraw for Medicare or one? So I don't
Mm-hmm.
know the answer to the, is it taxed? I would assume there's got to be something, but why would the government give you money and tax you at the same
And
time? It's
then
like, well,
tax it at the same time. Yeah. See, a lot of people think that Social Security is not taxed. So you're right. You have the Medicare come out, and we'll talk a little bit more about that here in just a minute. But not only that, if you earn through your investments, i.e., your taxable 401k, because you didn't pay taxes on the way into that traditional 401k.
right, right.
So that means you do, when you've deferred those taxes
Mm-hmm.
until later, which sounds like a great idea. More money working for you all up front, right? Everybody thinks, oh, yeah, do that all day long. This is such a great gift that the government's giving us,
Right.
right? Isn't that awesome? How about this? Would you rather pay tax on the seed, or would you rather pay tax on the harvest if
Uh,
taxes are charged as a percentage?
Probably on the seed. The seed is the lesser amount of money. Is that not correct?
There you go. Exactly. Exactly. See, the government, however much we want to complain about them, they hire really smart people to do their math for them. They know by allowing us to defer into retirement, we're going to have more money that they can tax. Okay. I'm not saying it's a bad thing to contribute to your 401k. I don't want anybody to get that idea.
Yeah, because I've always heard max out your 401k, max out all of your IRAs, max out any tax deferred money that you can put into an account. Is that not correct advice, or is that it's correct, except this is what you need to know?
Yeah, there you go. That's a really good point. It's correct, except this is what you need to know is that when you come out, so the assumption is, right, that, well, when I retire, I'm going to be in a much lower tax bracket.
Mm-hmm.
So then I'll pay less tax. Well, not really, because if you do the math, and if you are, even a marginally successful investor, you're going to be taxed on a whole lot more than you put in. You see what I'm saying? Because you're going to be taxed on the harvest.
Right. Exactly.
Unless you do a few things prior to retirement, and you may need a few years to do it. But if you do the math, and I know that's a 4-letter word that people don't like, math, but if you do the math, what you'll find is that even paying the tax in, say, the highest tax bracket,
Mm-hmm.
and say you've got 10 years to retirement, even, by the way, it's even works at 5 years, but let's say you have 10 years to retirement.
Mm-hmm.
Even if you pay that tax at the highest level, and you assume, and I know averages are not accurate, but just for the sake of easy math,
Yeah.
let's assume you're earning 8%. So you're earning 8% on less because you just paid the tax on it, right? You do that for 10 years, it begins to grow, right? But it grows at a smaller rate because it's a smaller amount.
Right.
But then here's the trick is when you start withdrawing, say when you turn, we're just going to say you retire at say 65, we'll just
Right.
make that up. When you start withdrawing, not only do you say, a lot of people will say, you can withdraw 4%, some people say 5%. It depends on the individual, right? How much they can withdraw in retirement to support their daily needs.
Mm-hmm.
Because if you depend on Social Security, you're probably not even going to hardly pay your rent, at least not if you live in California or Florida where we live.
Right.
It's just not going to cover it, right? So you need something else. So hopefully you've saved in a 401k or something. But when you draw that 401k, you've got to pay, say you're on the lowest
Mm-hmm.
tax rate, which right now is 15%. So we're assuming that even though we have trillions of dollars in government debt that rises every year, they're not going to raise taxes, which is probably not a good assumption, but we're just
Right.
going to be conservative and say 15%. So you're paying taxes on 15% of whatever you're taking out. So you got 15%, plus you got an average of 3% inflation. That's been a lot higher in the past year or so. But let's just be conservative and say 3%. So you've got to beat 3% inflation. Then you got to pull out your 4%. So we're already we're already at 7%, right? And then you've got another 15% that you're paying in taxes. And as you withdraw that out, depending on the sequence of returns, so if the stock market is down or even the bond market is down, whatever it is, and you're withdrawing that much, no one can consistently beat 15%, certainly not 15% plus the 7%. So you see how your assets in retirement just get whittled away very, very quickly.
All right. So are you saying that it doesn't sound like you're saying do this instead of putting money in a 401k or putting money in an IRA or any of the other programs that are out there that could be tax deferred? How do we make a determination as a consumer out there what the right percentage to put into a not a taxable account that will be taxed as the seed as opposed to, or taxed as the harvest, as opposed to the other way, which is put it all into a tax deferred program? How do we know what to do as a consumer?
And this is where, please sit down with somebody who knows all the rules, because there are rules centered around all of this. But the first one that most people are familiar with now is the Roth IRA. So you can contribute to a Roth IRA, and then all the money that grows into comes out tax-free in retirement. That's one way, but it's very limited.
Yeah.
And if you make too much money, frankly, they just say you can't contribute to a Roth. So there's rules around that. So then
before you go on, can I as a worker out there, W-2, 1099, whatever, am I someone that can contribute to a 401k or to an IRA or a SEP or something like that and a Roth IRA also?
You can do that.
Okay. Yep. It sounds like there are some income limitations though to any of those programs.
There are some limitations on that, but there's some other things that you can do. So commonly, so these days, new 401ks will allow a Roth option. So instead, like back when I was, working for corporate America with 401k, it was just you contributed 401k and it was tax deferred. Now there are options that my contributions as an employee can go into a Roth option, and I recommend generally, I'm careful to say that because this is not investment advice here on this podcast. This is just information that we hope people can use to call somebody like myself here at Guardian Rock, or somebody that can help you in your personal situation. But they now have the Roth possibility that you can contribute to in your 401k. Used to not be that way. But then the employer contributions, most of the time, are not Roth eligible.
Okay.
And when you think about that, that kind of makes sense, right? Because then you'd have to pay more taxes, right? It would be difficult.
Right.
So almost all 401k, 403bs, TSPs, if you're in the military or U.S. Postal Service, that type of thing, some of it is going to be taxable on the way out. And the common idea is, well, I can't take anything from my 401k as long as I'm working for that same company. I can if I move from that company, I can take it out and then maybe convert it to a Roth. And then, my goodness, do I have the cash flow to pay the taxes currently on that or not? And that's where a financial advisor can come in and say, well, this is how we might want to do it. We might not want to do it all at once. And there's no rule that says you have to convert it to tax-free, a tax-free income vehicle all in the same year. You can do it in stages. And I recommend for most people that they do it that way, so you don't put yourself in a higher tax bracket than you need to be. And then there's the idea that that's the only time you can do it is when you leave a firm. However, there is a rule, an IRS rule, that allows you to take distributions. Again, there's rules around it. We don't have time to get into it on a podcast. Nobody would remember it anyway, where you can take a certain amount each year for a certain period of years. And then you can take that money and you can roll it into generate tax-free income in retirement. Because ultimately, when you get to retirement, your assets, I mean, they're good to have, they make you feel good, and you like to look at big numbers, but ultimately it's about your cash flow.
Right. Totally.
It is all about cash flow. Forget about whether or not you own, a high flying stock. You want to make sure you have the cash flow you need to do what you want to do and build your best life in retirement, right? That's what we talk about all the time here on the show. So using all those tricks, maybe transferring some of that 401k money earlier than you thought you ever could into a Roth IRA, more than you thought you ever could, because there's no limitations on what you can convert from a regular IRA and a 401k into a Roth. There are limitations on how much you can contribute to a Roth IRA each year, and also income limitations. So those people in the higher income levels that aren't eligible to contribute to a Roth can still convert regular IRAs and 401ks into a Roth IRA.
Let me ask you this.
Loophole.
Yeah, let me ask this, because I think this is a point for someone that has been in the work world a long time and probably hearing a lot of the same messaging that advisors provide out there, which is max out your IRA or your SEP, max out your your HSA plan, max out all of those tax deferred things that are out there. And the consistency of hearing that message and the contribution that I was making financially every month, or that I continue to make financially every month to those programs, it just has got me into the habit of, hey, I'm just going to put $1,000 a month every month away for my entire life into this 401k or into this IRA or SEP or whatever we want to call it. So that practice doesn't have to stop if I just convert it to another vehicle. Like if I'm doing it to a SEP, it's just take the same philosophy that I have and just apply it to something else, right? To another potential plan. Is that correct?
Right. And when you hear that type of advice and folks are like, well, that's simple, that's easy, right? And it is. They're right. And then this is what I like to make things as simple as possible, but no simpler, right? Was it Einstein, I think, that said that? And that's what I think we tend to go to, right? We tend to go to this simple, and that's easy. Great. We'll move on to the next thing. But wait a second, dig a little deeper. You can do so much better for yourself and your future if you just make things a little bit more complicated and complex.
All right, let me ask this one question before we wrap up this episode. And I know this is going to create a whole bunch of questions that are out there in the world, not just my question that I'm about to ask, but everything that we talked about today. And for those of you that are in our community that are listening, we want to make sure that you are able to get in touch with John at the end of this episode. So stand by, John. I'm going to let you give that information in just 1 second. When you take that money that is sitting in this 401k or this IRA or wherever we're going to convert it to this other thing, this Roth, let's say, are we paying tax on the entire amount that we transfer over at the time that we make the transfer, or is that something that happens later on down the road?
No, that happens right then, and it may or may not be on the entire amount. It all depends on how it's set
Got it.
up and how it's been contributed to. So it can be different, and that's why you need somebody to help you
Got
kind
it.
of through that,
And one
unless you
other,
really want to dig into that stuff.
no, it's okay. And one other quick question. Do I pay the penalty? Because I always hear there's going to be a substantial penalty for early withdrawal, like I was taking it out of my 401k to use it for personal reasons, or is it as simple as making the transfer, paying the taxes at my current tax rate, and that's where my tax liability ends?
If you do it correctly, and that's very important, if you do it correctly, then no, you don't have to pay that penalty.
Okay, I got it. Lots of great information. This was probably my favorite episode because
Well,
because
one more quick thing, just
yeah,
so people know, right? You might be thinking, well, I can max out this all I want, but I still won't have enough for what I consider enough to be in retirement. So I have to save all in like a taxable account to really get to that number that I think I need to build my best life. There are things beyond the Roth, beyond the 401k that can generate tax-free income in retirement. And that's the kind of stuff that we can get into with a full financial and wealth management plan. But there are other things. So don't
all
give
right.
up if you think it's too little.
That was the teaser right there. All right, John, let everybody know how they can get in touch with you, because I know we've generated a lot of questions out there in the world. So tell everybody how to reach out.
All right, that sounds good. This is the best way to get in touch with me is to text the word life. So pull out your phone, type in 321-421-5213, and text the word life to that number. You're going to get my business card, and down at the lower right-hand side, there's going to be a link where you can schedule a meeting with me. Just 15 minutes. We're going to see if it's even worth your time, right, to chat. And then also on that link, you're going to get access to the podcast, my monthly blog. I also do a daily podcast just to keep people up to date, 5 minutes long every single morning, and all of the resources that we provide folks for free. Or just go out to Guardian Rock Wealth with a th.com and hit the contact us button. And there's all kinds of stuff out there on the website as well if you're curious about what it's like to work with us.
All right. Well, John, I appreciate you sharing your expertise and your wisdom. This was really one of those episodes where, because I think I'm right in the zone where it's like, okay, I really need to start focusing on this stuff. And maybe all this advice that I have been given over the years, it might be right, but it also might be worth taking another perspective on it as well. So thanks for being here. Thanks for sharing today.
All right, sounds good.